So now we're going to have a look at ordinary income. As we said, ordinary income is one of the key components of your assessable income, right? It's not defined in the legislation because it has its normal, everyday kind of meaning. Now, the idea of a gain is the idea of it's a form of, your income is basically a form of gain. It's a way you get returns. So your income is your change in wealth over the period plus any consumption over the period. Look, basically, the law only recognizes a gain for tax if you actually received it. So it's a realized gain. So for this reason, and particularly because the courts are going to distinguish between something that is income in nature and something that is a capital gain in nature. So don't get too confused with this diagram here. All right, one thing to point out is it might be a bit different in other countries, like the United States recognizes increases in wealth as being a kind of income. Australia doesn't. We draw a distinction between the income of something and its body or corpus of something, and we have a tendency to believe that income is about flows, and so it's repetitive in nature. So this is a bit of a diagram of the, Australians tend to use the fruit and tree metaphor for income, right? The tree is capital in nature, right? Yes, the tree can grow by itself, but it doesn't regularly reproduce extra other trees. It just grows in its own self. What you get are the returns that you can get from the tree can be the growth of the tree, so you can end up with more tree, but you can also get the income returns, which is the fruit that falls from the tree. And yes, you could use that fruit to plant a new tree, in which case it would, multiply. So our common examples of income are rent, if you receive interest, if you receive royalties, dividends, salary and wages. Now, there are certain cases where it doesn't necessarily always look like income. So the question is, look, when the person receives the money, what does it look like in their hands? What quality does it have in the recipient's hands? So it's not about what the company records it as. So if a company pays you some money, it's not what they record it as. It's not what it looks like to them. To them, it might look like they're repaying a debt. But to us, the matter is does it recur? Is it regular? Does it happen every so often? So that periodicity. Is there a continuing expectation of receiving it? And is one of the purposes of receiving it a profit-making objective? So those are the kinds of things that make us all think of something as income. It happens over and over again. We expect it on a regular basis, and the purpose is to increase the amount of profit or money that we have. The idea of come in and conversion into cash, generally for amount to be income, it has to come to you, usually in cash or something that is easily converted into cash. There usually is some sort of mutuality principle, the idea that there is a relationship between a taxpayer can't just derive income from yourself. You can't pay yourself, right? It has to come from somewhere else. Now, yeah, sometimes we get these non-cash benefits like fringe benefits where you get a car. Sorry, I just sneezed. Instead, you might be paid, given consideration in kind, which means you get a physical thing instead of cash, in which case we consider the monetary value is deemed to have been given to you. So what non-cash things? All right, we start to get into issues here. We talk about if you can't convert it into cash, we still treat it as if you can. The value, we have to take into consideration a few things, particularly if you're a business. Was it an arm's length transaction, or what's the arm's length of value? So yes, the other one company may assign you a certain thing and say, oh, well, it only cost us $500, but Is that because there was a special relationship there that got you a discounted value? What was the arm's length benefit? What exactly is preventing you from converting it into cash? Did you not really own it? So you don't control it? And did you pay for a portion of it? So if the company gave you, for example, a car is a good example here, right? A company that, let's say you work for Toyota and they provide you a car, right? They might say, well, they want to count it at the cost of how much it costs them to produce, but that's not really the arm's length value of a brand new car. If they provide it to you on some sort of leasing basis, or the idea is you don't own it, it's registered to them, then you might not be able to convert it readily into cash, but it's still counted as though you could, and you might have paid them, say, $10,000 for the car, in which case that's a contribution made by you back to the business. So fringe benefits often work like that. We consider if you had to make some sort of personal contribution back as well. It also matters whether if you had owned it outright, you would have normally considered it an expense and you would normally have been entitled to a deduction. So there is a thing called the otherwise deductible rule. So you might want to do some reading on that. And of course, it's exempt if it's under, if the whole value is under $300. It's just too hard to keep track of. So our categories of income. The main one most of us have is income from personal exertion, right? You go to work, you're paid for your services and your time and what you do. You have income from business. Running a business, you make a profit from trading. Income from a profit-making scheme, so you may have entered into some sort of commercial transaction to make a profit, or income from property, not including capital gains, just the income, the rent. All right, we can also talk about income as gross income or net income. So on the gross income, it's the total income, the total revenue from something. All right, whereas a net would be looking at, well, how much did you actually end up with at the end after you considered all of your expenses? So for example, a business will consider its ordinary proceeds, so all of its revenue, and we'll look at its gross income, whereas say if you're looking at a profit-making scheme, so as a business investing in something else, look, they're really going to look only at their realization value. For most of us, we get rewards for services, but we might also get some rewards or payments that are incidental to our employment. Like if you get a payment from someone for granting access to an interview for somebody, or some sort of voluntary payments, collections from a crowd for merit. Like so if a cricketer went out and passed his cap around and wanted people to pay him on merit, or payments by third parties, like a cash award received from a TV station for being the best and fairest player. So those things tend to be incidental to your employment. They're not the main way you get paid. Substitutes for income, so for example, a supplement from a civilian employer to make up the difference between the old wage and a new wage, so they may be considered a supplemental income. A personal gift depends on the relationship. So gifts that you make from family members aren't an issue. It's an issue if it's related to something to do with so if it's a personal relationship, it's fine. If it's a business relationship and there may be some expectation of business gain out of the gift, then it's a taxable receipt. For example, if you get shares, if you're an accountant and you get given shares from a friend who used to be your employer, that looks like your relationship was business. Money given by a solicitor, received by a solicitor from a former client. There's no expectation of future business dealings, could be considered a personal gift. You might also give up some of your rights and take payments for them. For example, people who take a payment in order to not trade, so a non-compete clause. So that's relinquishing a personal right, and that's usually determined to be a capital nature. It's also called a restrictive covenant. So trading transactions, so often when you trade with business, you might make gains on things, profit from land or selling of things. Those things, if that's the normal activity of your business, if you are a business that sells land, then that's the ordinary proceeds of your business. It's not a capital gain, it's the ordinary thing that you do. If you trade in land, then that's considered ordinary income for your business. That's different to capital assets. So let's say you sell land that you've been mining for decades and then you developed. Well, that's not normal income in nature, right? Because it's clearly capital in nature. You don't normally sell land. It's not part of your normal business. What you were doing with that land was mining it, and the fact that you later sold it and made a profit is not part of your normal income producing activities. If you're carrying on a business, this becomes a fun one. Are you carrying on a business, or is it really a hobby that sometimes makes you money? So it's a question of fact, what are you doing, and degree, how are you doing it and how well are you doing it? So some of the factors, we might look at the scale and the magnitude of the activities. So if you're just doing a couple of things at home occasionally, it doesn't look much like a business. Are you being systematic, commercial, and regular? Again, if you're not doing those sorts of things, it looks more like a hobby. And are you trying to do it to make a profit, or are you doing it because really it's fun and you occasionally make some money out of it? So is there a profit motive? So if you are carrying on a business, it's taxable. If it's a hobby, it's not. But keep in mind, if it's determined that what you're doing is a hobby, then you can't claim any losses from it. So you can have a loss-making business. You can't have losses from a hobby. So some things can still be a business even if it's small scale, short-term, athletic, and illegal. So what would we expect our ordinary proceeds? The revenue, the income that we generate. Usually it's quite obvious, but the courts can be quite broad in their determination of broad or narrow approach depending on your particular kind of business. Business restructuring. All right, if you've restructured a business, then that's, anything you've received from restructuring is normally part of the capital. If you're a life insurance company, it's assessed on the profit from the sale of your investments. An investment company is assessed on profit from the sale of shares. So basically it's the revenue, the thing you normally sell. If you normally sell assets, then the sale of those assets is your revenue generation. Share traders, you have to draw a distinction between, are you a person who trades shares as a business, or are you a mere investor? So if you are a share trader, then again, you're looking at scale, repetition, turnover. Is there a system? Then you could be earning income from share trading. Whereas if you are simply an investor who you tend to hold on to things for longer, you don't tend to have as much of it, you tend to have some other job as well, then your proceeds are considered often capital in nature and not income. You're not running the business of buying and selling shares. So a share trader is what some people who start as investors, who start doing it more as a hobby, tend to fall into the looking like a share trader when they start to make it look, especially when they retire and they start to trade vigorously and come up with systems and over again, it may look like they're running a share trading business. So that's something to be aware of. You don't want to be running a share trading business unawares. So there have been some cases. What have they looked at? Whether there was a profit-making motive, which in trading shares, one usually does have one. Are you intending to do it regularly? How complex is it? Is it business-like? Is there a clear pattern and the volume of what you're doing? So if a particularly relevant to making someone look like a share trader is how repetitive and regular the buying and selling is, how much money we're talking about, the turnover, the records they're keeping, do they maintain an office, how are they accounting for things, and is this their full-time occupation? Is this what they do? That makes them look like a professional share trader. Leasing and lease incentives. So you could be gaining money as revenue from leasing things out. It depends whether or not you're leasing it out permanently or it's a regular renting out of things. Intellectual property, so for example, selling patents. and things like that depends on whether that's the ordinary course of your business or if it's a one-off capital. Debt defeasance, so any benefit that is basically saving you an expense, so almost like for those of you who are accountants, contra expense accounts aren't exactly income, so you don't pay tax if you forgive a debt, for example. So a bad debt doesn't become income, it just becomes it can become contra expense. Isolated transactions, so sometimes there have been cases where unusual transactions have been considered income, particularly if it's a business transaction with a profit-making intention, even if it's a one-off. Obviously, we've talked about before income from property, the fruit idea, fruit from the tree. Rent received is income. Capital gains are not ordinarily income, but we will talk about them in the future lecture on they are statutory income. The loss of use of money, so basically when you give a bank money, you lose the access to it or the use of it if you put it in a term deposit and they give you interest. So that interest is income, which is what you are receiving is really a compensation for the loss of the use of your money. Any payment you receive that is a compensation payment for a loss of income is considered income. For example, if you've got an insurance policy that's income protection policy and it replaces your income when you become temporarily disabled, you pay tax. You count that as income protection payments. Those count towards your taxable income and you pay tax on them just as though they were the wages that they replaced. So if you receive an insurance payout that replaces an income item, it counts as income. If you receive an insurance payout that replaces a capital item, it's capital in nature. So it maintains its nature, the nature of what it replaces. So that's something to be very aware of when you receive insurance. What kind of insurance are you receiving? Reimbursements. There isn't a common law rule about if you get reimbursed for a deductible expense, is that really income? So Division 20 says, you have to read this, if someone gets reimbursed by their company, so for example, if you go and you fill the company car with petrol and you get reimbursed for it, if it would normally have been deductible to you and you've been given the money back, did you really receive income because you would deduct the expense? So you have to have a read of Division 20 of the 97 Act to see what kinds of recouped or reimbursed expenses do count as income.